Hey guys, what is up? So today I'm going to be showing you the best REITs to buy now, the best REITs for a bounce back play, the best REITs that benefit if we have another second wave of the virus. REITs are a great thing to invest in, super beneficial. On a lot of them there's very low risk and it's just solid passive income. So I'll be showing you guys how to get that passive income today. The safest ones to invest in, the riskiest ones, but the ones with the highest upside, so you can make some crazy gains on this. One of these went up 100% the other day, so one to keep an eye on. Yeah, you can make some crazy gains off these REITs. Some are super overvalued, some are super undervalued. I'll be pointing those out and just showing you guys how to invest in REITs and how I invest in REITs and the best ones to invest in. So let's get into it, guys. So my first of my favorite REITs to buy right now is UDR, ticker symbol UDR. So looking at the year chart, you can see there's further upside to be had, but there is essentially no downside to this stock either, which I'll get to in a second. So looking at the dividend yield, 3.59%, very solid passive income on your money. Just you'll get that quarterly, solid payments, and I believe this is a growing company as well, so you should get the price appreciation of this stock as well as this dividend yield yearly. So let's look into the business. So UDR is a very stylish, very high-class multi-family real estate trust. It has demonstrated performance history of delivering superior and dependable returns by successfully managing, buying, selling, developing, and redeveloping very attractive real estate market communities in targeted U.S. markets. So they're very smart at targeting the right location to start building at. They build up apartment complexes, and it's very stylish living, very high class. It's a growing company, and they know what they're doing. They know what people need as of right now, and they're capitalizing on everything. So at UDR, they're developing innovative technology, which is just they're growing with as new technology comes out and people adapt, they're adapting to what people are doing right now. So they're very smart at that. They have very good services, resident services, and they have a My UDR resident portal. So it just makes it super easy for these residents of UDR to access what they need through this portal. And it just makes things easier, and it makes people want to go to UDR for the innovative technology and just the ease of doing everything else. So during this time, during the Rona, one of the biggest growing industries is the pet industry. As you can, as with Chewy, ticker symbol CWY, we can see everybody's adopting pets. There's nowhere to get a new pet because everybody's adopted. All these pets have been adopted when people were quarantined during the Rona. People were adopting these pets. They said, we have time, what do? Let's get a pet, let's get a dog. So UDR has very pet-friendly apartment living. Some apartments do not allow pets in there, so that's a turnoff for half the people, probably above 50% of the population to have pets. So the fact that UDR offers all pet-friendly living, this is huge, first of all, because it maximizes the people that will come live there. Second of all, they're adapting to what people are doing as of right now. So people are getting these pets, people are upgrading their technology. UDR is with them both. I love UDR as a long-term growth play and an easy dividend beast. So the next stock we're going to be talking about is Medical Properties Trust, ticker symbol MPW. So this is a play on hospitals, the need for more beds and all that. So it's at a great growth opportunity and a great potential right now. Every location is needed as of right now. There's not any hits to the business. They're pretty much business as usual, if not more growth needed. More hospitals are needed at this moment because of the Rona going on. So it's a very healthy company, great balance sheet. Looking at the dividend yield, 5.33%. That is an amazing dividend, amazing passive income. Get that quarterly payment, and just get bank off the passive income. It still has ways to bounce back. It should get a full bounce back and more, just due to it. The business has not been hit at all from the Rona. So the only thing that has happened is improvement. The stock price is still down from its highs. So there's much more upside with this stock, and I see great dividend potential, great growth potential in the future. And let's get more of a deep dive into this business model. So MPW has 389 properties, over 41,000 beds, 8 different countries, and 41 tenant relationships. It's a self-advised real estate investment trust. It's been formed since 2003, and its point is to acquire and develop net leased hospital facilities. So it makes a ton of money on the rent. People need this. Countries need this. It's a growing business, especially with the pandemic going on right now. This is needed. So this is a big play, and I see virtually no downside to this, only upside and easy dividend passive income. So MPW is one of the global leaders in hospital finance, and as you can see, those yellow dots are its locations and where it's at. And its total portfolio is over 16.5 billion in value. Like I said before, 389 facilities, 8 different countries, and over 41,000 beds. So looking at where its capital is located at, 81% is general care hospitals, 11% is rehab, 2% is long-term care, and 6% is other. This is just a quick view of how much and how many locations they have in each different country, and how much is located in each state. Alright, so looking at the full numbers of the portfolio, so they have 260 general care hospitals, 106 rehab hospitals, and 23 long-term care hospitals. And you can read this, but what I was saying earlier, this just has growth potential. They're trying to grow as a business. I've read a bunch of stuff on this, and they're just trying to grow. Their number one is growth, and their number two is dividend payment to the investor. So they're trying to grow at the same time while putting the investor first. So some things that they're doing as a business is they're expanding facilities at new locations, supporting development of programs and services, recruiting new physicians and staff, and investing in new technology and equipment. So the big thing I'm looking at here is the investing in new technology and equipment. They're definitely changing with the times. They're up to date with technology, and they're just improving. So there's no bad things about this company. I've searched top to bottom looking for anything to scare me away from this company, and everything looks great, and the growth potential looks extra great. So some things that MPT can do is they have the capability to make transactions from 10 million to 10 billion and more. So their balance sheet is very solid. Their cash levels are amazing. They have ability to provide up to 100% of real estate value, so they can pay in full cash, and they have expertise in facilitating transactions at local denominated currencies for internal transactions. So this just means that they can make deals with other countries, they can expand into other countries. So this is an expanding business. This is a growing business model. More and more hospitals are needed at this time. So this is perfect for the time. The value is amazing, and the growth potential looks very solid. So I'm looking heavily into this stock, and this is a hold for the long term. Just another visual of some things that MPT can do. They improve financial positions for these different hospitals. They create liquidity, and they reduce taxes. So they have benefit towards the businesses that will use their real estate. And the last slide we're going to be looking at is some of the relationships and operators that MPW has with these different things. So as you can see, they have Surgery Partners, Dignity Health, UC Health, Advanced Diagnostics, and Life Care, and you can read all that. Pause it if you want to read all of it, but they have a ton of diversity, and it's looking very solid. Amazing business model for a real estate trust. So the next stock we're going to be talking about is AG Mortgage Investment Trust, ticker symbol MITT. So this stock has been hammered over the scare of the Rona and everything else having to do with that. As you can see, it was solid, steady stock price around $15, $16 ish, and it had dropped down to below $2, and now it is finally up to almost $10. It's $5.29. It kind of dropped back down for a second, but taking a look at this stock chart, it has crazy high upside, but there's a lot of risk with this stock. As you can see, the dividend yield says 34%. Okay, this is wrong. That is the trailing dividend yield. The forward dividend yield, which is the next dividend payment, is cut. They cut their dividend because they need to conserve cash. They're trying to survive as a business. There is risk of going bankrupt and all that stuff, so I'm going to get into that. But this is a big bounce back play. This could bounce back easily, get back a solid dividend, and start growing back again and get their business back together. So that's why this stock may be a buy. It is more of a bounce back play and less of a long-term hold. So this would be more of a swing trade until things get back to normal. So looking at the investor relations page, AG Mortgage Investment Trust is a hybrid mortgage REIT that invests and manages in a diversified, risk-adjusted portfolio of agencies, credit investments, which include residential and commercial. So the fact that it's commercial investments are getting hammered right now. The retail wave is coming to an end slowly but surely. Amazon is taking over, so that is why these commercial real estate properties are getting hammered in price, and this is why that this company is down so big. So can retail come back? Of course it can. But is it a shrinking business? Yes. So that is something we need to be aware of, and that is why this is not a long-term hold, but more of a swing trade, in my opinion. So let's go into the fundamentals and I'll show you guys what else scares me about this stock. So check out their income statement. The revenue is way negative. Revenue per share is negative. Gross profit is 124 million positive. The EPS is negative. So this is very unhealthy. This is due to the Rona causing all this panic in the commercial real estate, and these commercial properties shutting down, and this AG Mortgage Investment Trust not getting the payments from the companies because the companies were forgived. So these commercial REITs had to pay this off, and this is why the income statement looks so bad. They were not getting their payments, and therefore the company was hurt very badly, and especially their balance sheet was hurt very badly, which we'll look at in a second. But this company is scarred, so it's never going to be back to normal. But it does have more to bounce back, which is why I still like this stock as a swing trade with a small speculative position. But I'll get more into that in a second. So this is where you can see that it gets extra risky. So they have 95 million in cash, and they have 1.17 billion in debt. This is horrible. REITs usually do have a lot of debt just because they're owning property and they have that debt to pay off. But this is substantially high, and this is scary to me. On the other hand, it is a REIT, so they buy real estate and they pay it off slowly from the commercial payments, from all the payments they get. So that is okay for a REIT. But 1.17 billion in debt, this scares me. If there's another shutdown, if anything else happens, I will be scared for this stock's life and this company's life. I would expect bankruptcy. So this is, you can ride this wave while the economy is improving, while the Rona is going away slowly but surely. But if the Rona comes back, if the second wave starts again, get out of this stock, cut your losses immediately. But this is a very high upside bounce back play with the economy coming back and the Rona stopping, if it does stop. So be aware of that. So lastly, we will look at the dividend. So as you can see, the trailing dividend rate was 27%, but the forward is the next payment that will happen. So looking at the forward, it's not available. That means they cut the dividend. They will not be paying the dividend. They are conserving cash to survive as a business. So coming in the future, you will not get this dividend payment until they bring it back. I'm not sure when that will be, but I would not be using this investment as a long-term dividend stock. I'm using this once again just as a short-term bounce back play. So the next stock I'm going to be talking about is Invesco Mortgage Capital Incorporated, ticker symbol IVR. So looking at this stock chart, you can see the 1 year chart. It's down about 70% year to date. It's currently right at $5. $4.99, $4.90 after hours. So looking at this, there's a ton of bounce back upside. I really like the potential in this. I really like the bounce back potential, and I like the upside in the value in this stock. Now, it's not going to be a long-term hold. It's not going to be a growth stock, and I'll get into those reasons in a second. But this is an amazing value and a great swing trade in my opinion. So looking at the investor relations page, Invesco Mortgage Capital operates as a real estate investment trust that primarily focuses on investing in financing and managing residential and commercial-backed mortgage securities and other mortgage-related assets. Invest in residential mortgage-backed securities and commercial mortgage-backed securities that are guaranteed by a U.S. government agency or federally chartered corporation. And the ones that are not issued or guaranteed by the U.S. government agency or federally chartered corporation, the credit risk is not worth it to this company, and they will not invest in those that are not guaranteed by the U.S. government. So a big goal of this company is to have it risk managed, to have everything backed up by securities, backed up by the government, and they just have a very long history of doing this. very long history of dividend growth. So this is a big dividend play. The dividend has not been cut, and I'll show you guys the dividend statement in a second. But yeah, this is just a great value and low risk in my opinion. And like I was talking about earlier, here is the investments that they have with the agency RMBS and the non-agency RMBS, which is residential mortgage-backed securities. And also the CMBS, which is the financial commercial properties. This is the scary thing, because I do have some investments in commercial properties, which commercial properties are the one scary thing to me right now. The commercial properties are getting hammered by the Rona, and commercial properties are just kind of slowly dying off due to the Amazon, the internet retail services. So looking at the income statement, you can see the revenue is over 410 million. The profit is over 410 million as well. The net income to common is 319 million positive, and the EPS is positive 2.4. So this is a pretty healthy income statement. It looks good to me. I have no worries with this income statement. So like I said before, REIT balance sheets are very scary due to they're just in a lot of debt because of all the real estate that they've acquired. But look at this. So they have 191 million in cash. Okay, not bad. And then we'll get to debt. They have 19 billion in debt, which is absolutely insane. This is what scares me about this company. This is why I would not hold this company long term. And this is just the one reservation that I have about putting a lot of money in this stock. And the reason that I wouldn't be more than a speculative position because of this debt level. 19 billion, that is not healthy for any company. I don't care if it's a REIT or anything else. It's just very unhealthy. So let's look at the dividend. And yeah, keep this in mind. The debt is scary. So this, believe it or not, this company is paying a dividend. The forward annual dividend is 40%, which is a great dividend. That's making 40% on your money per year. I don't know how sustainable this is just because it's gotten hit so hard. I would bet that this goes down to like below 10%-ish, because 40% is just not sustainable for any company. I don't care what it is. But yeah, it does have a forward annual dividend rate, so that does mean that it's paying a dividend as of right now. It has not cut the dividend yet. They're increasing their dividend by 37.6% to 40.65%, so that's a 3% increase. But keep in mind that there was a big drop. The payout ratio was 76%. This isn't bad for a REIT company. The 5-year average dividend yield is 13.73, not bad at all. So yeah, the dividend date is June 30th, so if you're holding it May 20th, you'll get your payment on June 30th. That's what that means. I'm not for sure when the next one is, but I would be guessing it's the next quarter, so in August sometime, maybe July. I have the ex-dividend date, so keep this in mind. The dividend may or may not get cut. I would guess that this 40% does not last at all, so keep that in mind. But this is a solid swing trade. The debt levels is concerning, but I do like it as a swing trade. The debt is the only thing that gives me reservations. I like everything else about the business. I like how it's backed up by all these securities and the government and everything else. So that is what I think about IVR. So those first two REITs are very safe, very long-term, very high dividends, and very solid. Virtually no downside to those first two. Those first two are my potential favorites. And those second two, those are the high upside swing trade ones. I don't like those long-term because of the debt, because of the short-term risks. But I do like these as a swing trade. You could double your money easily in these in the next couple months, which you can't double your money in the other ones. You could over time. I would not bet on it happening anytime soon. So it's upside versus risk. What kind of investor are you? Are you one that needs upside? Is your risk tolerance super high? Go with those second two. If you're one that is a long-term investor, you like holding on. Even as a short-term investor and long-term investor, I would prefer those first two, just because I don't like a lot of risk, and I do like taking profits. Those dividends are amazing, and like for example, the medical properties, that is just growing and growing. That industry is growing. I would not like to invest in a commercial property because that industry is sinking. So you got to go with the growth opportunity, but keep those second two in mind as short-term speculative swing trade opportunities. So all these REITs are great investments potential, and I'm super bullish on all four of these: short-term, long-term, mid-term, whatever you want, whichever one you want. Just go with the right time on that. So I hope you guys found this video super useful. I hope you use these to make a ton of money off of, and I hope you all enjoyed the video. Check the links in the description if you want to be a member of this stock group. If you want 2 free stocks on Webull, use the link in the description. You get 1 free stock valued from $14 to $1,400 and 1 other one. And if you don't like Webull, just get that $14 to $1,400, get it, take it out of the account, move it to your other broker, boom, free money. So the Webull link is in the description. If you want to get that free stock on Robinhood as well. And if you want to check out any of the investing books that I use to educate myself, those are in the description. So I hope you all enjoyed. Thanks so much for watching. Let's get rich.